session's scheduled for about 45 minutes, so I'm going to try and make it as interactive as possible and let these guys do the talking. So I thought I'd just perhaps kick off with just understanding the sort of audience that we've got here, just to give these guys a better chance of answering maybe the questions and everything. So, developers in the room? Okay. Money, financiers, investments? Okay. Brokers? Anybody else? Brilliant. Thank you for that. Just wanted to kick off because, real estate hospitality these days, I think, is very much sort of blurring the lines with so many different aspects of real estate. So perhaps, Vadrana, could you outline a few reasons for what's happening out there in urban living?
I mean, just to kind of kick off, what's happened in my experience over the last probably decade is that the rooms have become a lot smaller, whether you're looking at hotels, apart hotels, residential units. And I think the space planning has become a lot more efficient and things like that. But the reason for it is actually being able to deliver and make a profit from your development, because land prices have continued to increase. But it's also led by customers, because what do these customers want? They actually don't want just a boring room to sleep in with an okay bed. They want an amazing mattress, they want a beautiful design, and they want pretty much everything. But I think we'll be talking a lot more about community and the guest experience. But my personal view is that, basically the industry has completely transformed in the last decade. And also the sales channels actually are quite interesting, because everyone used to go to, say, Hilton.com and book their preferred hotel bedroom. Now we have TripAdvisor that gives us a lot more insight into what the hotel really is. There's Airbnb, and the OTA business tends to take up quite a massive chunk of actually the hotel revenues. So,
all right. So
changing industry.
The developer on the panel, Southern. Talk through Future Generation and the brand that you've got from a student housing perspective.
Yeah, no, absolutely. I mean, I completely agree. Even from a student accommodation perspective, we put a lot of focus on the amenity spaces and the communal areas. The bedrooms are the bedrooms, okay, but for us as a developer, what sells a scheme is actually, when a student walks in, it's the amenity spaces, it's the communal areas. That's what convinces them to go for one. Live here and not there. It's that sense of community that we're trying to foster in these developments, really, which I think is reflected in other assets as well. The co-living stuff is even smaller room, but then you have huge amenity spaces, and that's why people are choosing to live in those kind of developments. Yeah.
And through your experience with Future Generation, have you seen any sort of shifts in, we've identified the rooms are getting smaller. Is there an increased service element to some of the student housing that you used to do to what you do now?
Yes, so I mean, one of the key things that has been quite popular in our recently launched developments is the weekly cleaning of the community spaces. So the kitchens within a shared apartment, they get a weekly cleaner. So it's making it easier for the students, so they don't need to worry about that. And then, on the other hand, within the rooms, in terms of more of a service or a feature, if you will, is air conditioning. So we're putting that now into all our bedrooms and all the kitchens and community amenity spaces. And I'm not aware of other student housing developers who are doing that at the moment, but I think that's the future. Last summer was incredibly hot. I don't know what's happening to the climate, but I think air conditioning in the UK needs to be a lot more established. So it's that keeping up to date with changes.
Yeah, just to jump in, actually, it's very interesting, because no later than yesterday, I was working on a project which is actually a build-to-rent scheme in the greater area of London, very close to a very famous stadium. And we're looking to put a hotel right next door. And so we were working with the JV, our JV partners on it. And what's quite interesting is that's exactly the debate we were having, is do we provide, or do they provide cleaning, weekly cleaning to their residents within the rental scheme? And the biggest question was actually VAT. How do you account for VAT on those cleaning services? because obviously build to rent doesn't attract VAT because it's all on ASTs, whereas the hotel obviously would attract VAT. And so how do you account for cleaning?
Yeah, student accommodation is obviously, again, doesn't
Attract
attract,
VAT.
it's on ASTs as well, so that's a very good point. Yeah, VAT in general is, it gets really complicated, but it's as the guys here will testify, it's a huge thing. There are some really odd things, for example, carpets, VAT on carpets is irrecoverable, so going forward we're no longer using carpets in our bedrooms because just because you're putting in carpet, you can't recover the VAT, whereas if you put in something else like vinyl flooring, for example, you can recover it. So it's boring, but it's super important.
What's interesting is that each sector will have its own nuances, but actually there are principally three reasons why we're seeing some of the smaller sectors more in focus now, and essentially one is natural evolution, so there are some sectors which are growing. I'll take one example, care homes now going into assisted living and supported living, hotels going into service departments and so on. So there is that natural evolution. I think the other reason is borrower demand. I think people they require more flexibility and therefore want to see different product out there. And I think the third thing is that in many markets, yields have been relatively compressed, and so actually investors and developers are looking for areas where they think that they can secure greater yield, and some of the niche areas that we're seeing, what we call the alternative sectors, are actually providing the yield that's demanded.
But I think it's also about attracting the customer at the end of the day, because we were talking about competition and the blurred lines of hospitality versus build to rent and actually student housing. And we're all trying to sell to a market. And so how do we become the most attractive product to those customers? Which obviously, there's a blurred line between how much service you provide, which obviously comes at a cost. And
Yeah, I mean, sorry to jump in, I can sort of talk to that as well in terms of our experience with student accommodation insofar as, say, 5 years ago, amenity space was a gym and maybe a cinema. Now amenity space is a mindfulness room, a yoga room. It's that level of service has really changed. And I think developers are starting to really think about the end user a lot more than perhaps they used to. But that's just my experience from a student accommodation perspective.
And staying on that from a funding perspective, how difficult is it when you're looking at a mixed use scheme with service departments, student housing, build to rent? What's most important from a funding perspective for you guys when somebody comes to you?
Yeah, we're not. Amenity space is great, but we're all about is the rent sensible for the product? I.e., are you building? If you're building a student accommodation scheme, is it effectively like a hotel? Is it really high end? And are you trying to achieve rents that are above market, or are you providing something that's more basic? And do the rents fit in line with the market? That's what we're more interested in, frankly. But you also want to make sure that if you are, I don't know if you mind me saying, but the future generation stuff is pretty high end. It's sort of as good as you'll see in most of the student markets that we operate in, and they achieve a premium on rents as a function of that. So that's what we really look at, the balance between the spec and the amenities and the rents that are looking to be achieved.
Yeah. Anthony, you're sat there quite quiet at the moment. Would you like to talk through maybe briefly what Volume Property does? And
so we're a development company. We from the full cycle, from sourcing sites to getting planning to building them out, operating them. So we're sort of a full cycle developer, landlord, operator. It's pretty interesting actually because prior to that, prior to my development company, I ran a lettings and management operation, so I've had exposure to a lot of the sort of parts of the student market, whether that's from the HMO to purpose-built student accommodation to apartment rentals and the rest of it. So it's pretty interesting where things have changed now in the direction of the market, and as you say, more amenity space and making good use of communal spaces, but also trying to couple that with rents that are realistic. You can provide as much fancy amenity space as you want, but if your rents aren't priced correctly, then there's going to be some difficulty there making it stack. And from a finance perspective, it's not going to be viable, plausible to do. It's great to provide the amenity space when it comes to these schemes, But, you know, and as someone was mentioning earlier about the price of land, it's a lot more competitive now. Prices have gone up. So to try and balance with this amenity space that doesn't really generate much money, it adds a little bit to the scheme in terms of how nice it is and potential benefit in an additional amount of rental that you can get by having the additional space. But the real money maker comes from the actual renting of the rooms. So that's where the challenging is really finding out what spaces are being used. I mean, how are you actually assessing what is actually being used by students and how many?
I think the trick is really to have kind of adaptable spaces that you can actually change further down the line with not much required. But you know, we think we know what the students want at the moment. That doesn't mean they'll want the same thing in 5 years down the line. At the moment, you know, it seems like this current generation is really into health, you know, well-being, fitness, you know, which is pretty good. So, you know, which means that, you know, what used to pass as a gym in a student accommodation, you know, 5 years ago, 2 treadmills and a bike just doesn't cut it. You know, you have to do an actual gym, or in our case, we're using these virtual classes on a big screen where you select what you want to do. But that could easily change into a cinema room if you feel like you know, if you feel like that's going to be used more often. So it's about having flexible, adaptable space that you can, you know, further down the line, 5 years down the line, just change as well.
This is actually quite an important point, because it then goes back to the operational side, which is essentially often understated, and more to Sky's point about how do lenders look at this. Essentially, the golden rules of lending, of course, know your asset, know your borrower, know your location. They're compounded by these other sectors, so PBSA, hotels, care homes to an extent, by the fact that there may be an operator, a third-party operator who's operating, and therefore you as a lender would want to know who is the operator, what's the operator's covenant, and actually what services are being provided, because, and also more fundamentally, how is the operator tied to the lender under a duty of care agreement or direct agreement or something like that. So you would want to build all of that in, and the operations are absolutely key, because if you have your asset and you have your cash flow, and the operations clearly go to cash flow.
Yeah, no, absolutely. Just to pick up on that particular point, I think when it comes to the operator selection, it's not even, or the operator choice, it's not just the covenant, it's the experience that matters the most. And also linking back to what is your actual business plan. So talking about rental products in the residential space, are you letting your building on ASTs, or are you doing short lets? Because that is a completely different business model. And when it comes to lending in general terms, whether you're looking at underwriting a development, which will have an element of stabilization, you actually do have very different pockets of lenders, depending on the style of operation you have. So you'll have obviously the specialist hotel lenders who will underwrite cash flow income, whether it's a development and then, you know, develop a hotel development that's then stabilizing, and where the exit will come. But the value of your hotel is an actual function of your bottom line as opposed to your top line. And understanding that cash flow and having the right team on board is exceptionally important. And and obviously then we can talk about brands and obviously that adding value and strong distribution channels. And again, when it comes to the resi space, if it's a brand new product, having someone like a JLL on board to help you do your lettings will provide the lender with comfort that actually it is likely to let, and you're not going to end up with a half-vacant building, regardless of how nice you've made it.
Yeah. I think it's important from every lender's perspective that you don't just decide because this is the space that everyone's now operating in and interested in, and that this is where all the investment money sits and the overseas capital that's coming in, that we now wade in and start lending in this sector without ultimately understanding what each individual asset class offers. So we've, in Maslow, have invited in valuers that specialise in build-to-rent, co-living, and then sometimes you get a mixed, as you referred to, a mixed planning, where you've got different elements of all of those asset classes in the one. And then you have to wrap your head around, well, how do you present that to your investment committee as to how that's valued? So what you just go back to the basics of business is that you look at each income stream in isolation and see how that's derived and where the operational costs come from. and you work back to what has been the achieved yield in each of those segments and sectors over the previous 12 months and what transactional evidence is there in the market. Because it comes back down to evidence-based lending and what that asset has traded at. And then you have to get into the nitty-gritty of where each of those marketing business plans sits, how they're going to market themselves. And if you get, in my view, you've got two types of, and maybe three types of developers. Someone who's very experienced in the sector in which they operate in, and a developer who has typically in the last 10 years traded in the residential space and has now said, right, well, I've got a lot of risk here. This is where it's headed. I need to diversify. I'm now going to start bidding and looking at serviced apartments, but I've got no idea about how to run it. So I get in an operator. Trying to choose an operator at the end is very difficult because you've got operators that will look at overpaying, in my view, from a rental perspective and that lease to obtain market share in the UK. But they may have a very strong presence in the rest of Europe. And then you will have an operator that's based in the UK who's very established and is a very good covenant, and their lease is achieving very good yields from a sales perspective. My view, I would back that transaction with the proven operator at a lower rent, but gets a better yield at the other side. So it's a longer term play from a stabilisation period. So you can't just say, right, well, we're now funding co-living, we're now funding build to rent, without understanding how the end value of those transactions and where that business plan comes into play. So it's a much bigger picture.
Yeah, no, super. Thanks, Emma. Just coming back to you, are you seeing failed resi moving into serviced apartments, for instance? An increase? I've seen a couple. Just that's.
You're probably referring to what was and is termed micro units.
Well, it's maybe developers that have had a resi project priced at a certain point. They're not selling them. They're sat on it, and they need to generate income. Yeah, you seen more of that, or?
I've seen a couple of cases of that. I've seen people who've got a residential consent. We do a lot in the northwest, and typically the model that those developers adopt is they will pre-sell units off plan, take large deposits, use that to fund the first element of the build and find a funder to do the rest. I've seen developers unable to sell stock and then flip that into a build to rent product. I've not seen it into a serviced apartment. I've not seen the actual planning change as such. Okay. I've seen the business plan change. And I think that will become more prevalent as time goes on.
It's interesting because we bought one actually in Manchester.
I hope I've not said the wrong thing.
I mean, typical story. So obviously, built in or around 2010. Obviously, it was quite a tough market. The whole thing went into administration. Someone else picked it up very, very cheaply, I may say, and they plugged in an operator to just run it as serviced apartments, and we bought it from them. In 2018, I think it was August, and actually we changed the planning because we wanted to tidy up the planning history because they traded it for 8 years by that point in time as effectively as an apart hotel, so as a commercial venture, and they weren't paying VAT. I mean, it was quite funny, and it ended up being actually the most challenging planning process I had ever been through. It turned into a massive political debate because obviously Manchester now has a big shortage of housing, right? And the local councillor was, why were 84 homes taken out of my county? And it's actually quite fascinating. We ended up getting it. I mean, they really didn't have a leg to stand on because those units were never actual residential units. But yeah.
With planning, if you look at co-living, it's consented under C3 for straightforward residential, and you operate it under a HMO license for co-living smaller units. So the view could be taken that if you were to explore lending into co-living, which is a new sector, how can you get a committee or investment committee comfortable with that? And you would lend on the GDV of the C3 class, and maybe a portion that is your backup exit plan should that not work out in terms of co-living, because co-living is the next movement on for professionals from student
accommodation. Yeah.
I mean, I don't know if you've looked at co-living opportunities with that being the next stage.
Yeah, I mean, we've looked at it very, very broadly. It's not something that is on the top of our agenda, to be frank. although I personally I think it's an interesting space. It's actually, from a development perspective, actually very similar to Sweden, because it's all those products are based on the way it's designed and the repetitiveness of the units, the small dwellings, the shared apartments, the risers all stacking up so that the building runs efficiently. That's kind of what differentiates them. So to the earlier point, we probably have the transferable skills to get into that space, but it's not something we're focusing on just now.
Okay, I'll open it up to questions in about 5 minutes. So if you have got a question, just be ready. Hotspots. Vadrana, you've taught Manchester. What are the sort of hotspots at the moment?
I like to talk about cathedral cities, especially in the hotel space, but I guess that applies as well for PRS and other sectors like that, student housing in particular. Because the advantage of cathedral cities is that you will always tend to have a certain scale. You'll have your corporates, you'll have your leisure, which are obviously very, very necessary in the hospitality sector in particular. And you will have the right demand drivers. So we tend to focus on city centre locations in the likes of, obviously, London, Manchester, of course, York, Bristol, Bath, Cambridge, Oxford, obviously exceptionally strong markets if you can get land there. And Scotland is still very strong. I mean, Edinburgh is still very, very buoyant. Glasgow has seen a lot of supply, but it's still a very strong city from our standpoint.
Wow, that was 30 seconds of any sort of unicorns that you've got your eyes on? I heard this phrase called hipsterbia last week, and it was basically non-urban, in between urban and rural. So these people maybe who aren't looking for urban, but a bit of rural with leisure and urban and everything else. But anyway, that's another.
Well, I guess as you say, it's identifying the next hotspot within a city.
Yeah.
Because finding a site in Leicester Square, let's be honest, is exceptionally unlikely. So it's trying to identify the next Shoreditch, the next Bethnal Green, and things like that within certain locations. And some guys have done it exceptionally well, guys and girls, of course. And and I think those areas do exist in every single city. They're quite hard to find, but actually the Manchester project I mentioned, so we're in Piccadilly Basin, which is edge of Northern Quarters. And in the last 6 months, there are 2 really, really fancy hotels that have opened nearby. There's obviously the Native product and the Dakota. So very happy about being that particular growth area of the market.
Yeah.
Because that's where you'll see the most growth at the end of the day.
Yeah. Yeah, we've mentioned, sorry, go on, Anthony. Yeah.
I was going to say, in terms of hotspots, I think, as you made a good point, the next Shoreditch, Croydon, I think if you're, depending on your approach as a developer, you can potentially make the next hotspot or the next area. And I guess it's down to the number of transactions you're doing within that area that you've identified or the size of that deal. So if it's quite a large sort of regeneration project, then that can have a massive impact in, usually it's expanding somewhere that's quite vibrant, isn't it? So if the city centre is quite lively anyway, then it's probably going to be on the outskirts of that. And if there's a great opportunity there, for instance, there's a lot of industrial buildings, something that we certainly target areas that tend to be quite industrial, but they're still on the outskirts of or pretty much within the city centre. There's a great opportunity there to turn that into a new. Sorry?
What about Tottenham?
I don't do anything in London at all, but I mean, I'll add that to my list.
It's a good point, actually, because most proposals these days have some element of placemaking, and actually it's a word that probably we weren't using maybe 5 years ago, and now actually there are a lot of developments which have some kind of community or social feel to them, and it may well be that these areas that we're talking about lend themselves better to that sort of thing. Yeah.
I wanted to bring up brand, because that came up in our conversations earlier, and the value of a brand, and there's so many fresh, innovative brands, challenging the norm. From a sort of lending perspective, is the value of the brand sort of really important to you, or more important than it used to be, or less important, if there is a brand at all?
Yeah, I mean, I can only talk from a student accommodation perspective, but I think that brands that have a good track record will do better over those that don't. So if I think about a Vita student or a Fusion student, those are both very, very recognizable brands that people want to live in, and I think they will outperform versus local competition, is my experience. So I think there is value in it. Tangible value, probably not, but there is definitely value in it at the end of the day.
Okay. Has anyone got any questions at this point?
We touched on co-living space and micro-living somehow. Just wondering what you guys think, or how do you think this space is going to affect the residential market in the next 5 years?
Who wants to take that one?
So, having explored co-living to quite an extent over the last number of months, so we started by looking at built to rent, and then we've explored co-living. I do not feel that co-living will impact the residential market if you are focusing on residential from an affordability point of view and sticking to help to buy stock in good locations, which is where everyone wants to be, right? But with regards to co-living, when I look around the office at 8 a.m. or 8 p.m. in the evening, young professionals want to leave, at 8 because they're working longer hours, right? Because they want to get to where they want to be. They want to go back and pick up takeaway on the way back, go up, change their clothes, go down to the gym, go back in, and they go to work in the morning. This is what they do Monday to Friday, and then they may go back to... So it's suiting that type of lifestyle. If it's your first time to buy, or you're looking for your first family home, that is not going to impact that sector at all, I don't think.
Basically, it's like a niche client or a niche demand for that type of living space.
I think it's targeting a certain lifestyle at a certain point in that person's life.
I'd agree with that, and I'd also say that actually there are question marks about scalability in co-living as well, but also outside of London, where property prices are generally and rent is generally cheaper or less, whether people would actually go and live in a development with other professionals if they have a choice of where to go and where to live, potentially.
I don't know about you, but I'm sick of talking to him by 6 o'clock, so I don't know if I want to be after that.
Cool.
Yes, sorry.
Yeah, so it might be a more general question for Ranjiv, but for anybody. In terms of these different schemes, which one would you say has the best payoff in terms of, legwork ratio to profit?
So between hotels, PBSA, and serviced, I think hotels and PBSA more the mature sectors, so bigger payoff, I suspect. Clearly different sectors, so people are in those areas for the different reasons. Yield-wise, I suspect at the moment they're relatively comparable. But hotels are a much more mature market, actually. So.
No, I'll jump into that one. They are very different sectors. That is completely correct. And I think they're very, very hard to compare. The two easy metrics are yield on cost, because at the end of the day, it's how much you're going to spend to get there and what return you're going to get in terms of income at the end of the day, and return per square meter, which is another very interesting metric we've added in all of our IMs. And I think residential still shows and throws very strong returns in the UK, so definitely not to be sniffed at as an asset class. I think offices in your super prime locations like City of London, things like that, will probably give you the keenest yields. When it comes to hotels, they are a lot more mature as an asset class, but even for freehold hotels, because you're taking the trading risk, it is still, it's high yields, let's be honest. Even in London, you'll be like between 4 and 5% against offices, which can be sub 3. So there's a massive differential. However, your earning potential is massively higher, and I think the fact that the institutional investors have now come into that trading risk market is definitely having a positive impact in terms of the yields and things like that. So I expect we'll see more yield compression in the hotel sector in particular. But yeah, and then industrial. Industrial is incredible value for money, right? You can still build it relatively cheap. The tenants, there's a huge amount of demand for logistics and industrial and things like that, so still relatively easy to let. And the yields have dropped like there's no tomorrow, as in dropped in the right direction. So they've compressed absolutely hugely. So yeah, but I would definitely not sniff at residential when it comes to it.
Rajiv, with are you seeing, obviously retail is in a difficult place at the moment, and the high street, etc. Are you seeing any schemes that are sort of mixed use based around in more high street sort of locations? We touched on it earlier, office, what was 10 years ago?
So anecdotally, there are moves now to do more in the retail to hotel space, and actually that's seems like a sensible thing, and it seems like a win-win where essentially underused or unused retail space is converted into hotel space, and actually that then in turn it generates greater footfall for the shopping centre or the area where that hotel is, and the hotel can then take advantage of services around it as well. So that might be dare I say, kind of one of the next big things, certainly a development that we've been reading about and talking about as well, possibly in the same vein as office to resi and so on, which now has been done many times over.
Yeah. Anybody else seeing that, or Vajana?
No, interestingly, so we've looked at a few, as we discussed a little bit earlier, and actually we ended up losing to an office scheme. In terms of, we were looking to do, it was an established shopping center, very big brand, got into trouble, as you can imagine, so they wanted a lot less space within the building, and actually our fit-out costs, which is why I'm talking about yield on cost, were a little bit too high for basically the guys who were looking at it, and well, together with us on a JV basis, but office was a lot cheaper to deliver in that particular building, because if you imagine a nice kind of department store, you do have your floor-to-ceiling height, you do have okay aircon already, not good enough for a hotel in terms of intensity and things like that. You would definitely need to redo it if you were doing a hotel in there. And your M&E costs were just so high that actually the office scheme won over us.
All right.
And I generally agree with you. I think there's a huge amount of opportunity in the retail space, and we're looking at quite a lot of retail at the moment because obviously prices have dropped very significantly.
Okay, we're almost out of time. I'm going to ask you individually in a moment a hospitality or real estate brand that you admire and why, very briefly, one by one. If we've got any more questions before we wrap up. Yep, a microphone there, thank you.
Hello, I work for a bank, so we have recently seen lots of cases, lots of sale in the small hotel sector. So I've got a number of customers who are buying hotels which are kind of distress sale or probably not performing to the line. So I want to understand how do you see this market, say a hotel of 5 or 10 million pound, these kind of market, are these so you talked about the compression in the yield of the hotel. So do you think these are which sector of the hotel you think is the most affected?
How big are those hotels? Because the price doesn't mean anything. How many rooms are we talking about?
Probably 150 rooms.
Okay, so that's very efficient operationally.
Right.
If you're looking at a hotel that has over 75 rooms, normally you get really decent economies of scale. How big are the rooms?
I've not seen.
Okay, fair enough.
But seems like
so, the bottom line is, again, going back to what we were talking about earlier, which is experience, management, and things like that, we pick up all the time hotels that are actually not doing really well operationally, and our business plan is value add, so we're not proposing to add any rooms or anything like that. We'll literally buy it, change the entire management structure, and run them a lot more efficiently, and that is, and spend a bit of money on them as well, make sure that actually you attract a slightly better rate and things like that. Often we'll also look at rebranding strategies and things, but as I said, it's completely location dependent. Your yield compression, that was industry-wide, just because there is a lot more appetite for hotels as an asset class, but on an individual hotel basis, there's so much you can do to improve the value, and as I said, it's not the size that's going to dictate the value improvement, it's what you do with it.
Right. And I work in the city of London, so I see lot of residential apartments in the city are kind of empty, they are not let out. So how do you see is it going to impact the valuation for these high value apartment, 1 million apartment, 2-bedroom apartment for $1 million or so? These are supposed to be land on say as a service apartment or Airbnb, but these are empty. No one is taking them. So do you think this sector is going to have an impact?
Whereabouts in the city are the apartments?
Yeah.
central London kind of.
Are you talking high-end resi?
Yeah.
Yeah. So a lot of these apartments are purchased by overseas investors, and they're quite happy to leave them sit vacant because the minute you put a tenant into them, you lose what's perceived as your new build premium, which could be up to 10% of the overall value. So they're quite happy to leave them sit untouched for 5 or 6 years, get the yield growth off them, and then resell.
So what do you
Yeah,
think?
and to add to your point, actually, the problem you have with new build or newly refurbished apartments, the second you start letting them, they'll drop in value. So
Right.
when it comes to actually the new build sales market, you are going to affect actually the valuation of your residential, but it all depends on what you want to do with the asset. If you as the lender are repossessing it and all you want to do is try and get some cash in the bank, it may actually be worthwhile you just seeing how much you can get for them bulk rather than going through the pain of trying to manage it through Airbnb or whatever. Because, I mean, if they're really well located, getting them let on a medium to long-term basis via like a corporate housing style agent or something like that could work really nicely, and you would definitely be getting more than your traditional rents. But as said, it depends on what you're looking to do with them. And as you're saying, sometimes it's best to keep them untouched.
So do you have a view on the valuation of these? Sorry.
Can we perhaps have that conversation afterwards? I think the guys are hanging around, but we will sort of bring it to a bit of a close. So, Rajiv, a brand that you admire and why, just quickly.
In the hotel sector, Hilton, just because they're massively consistent.
All right.
Never had a problem in a Hilton.
Vajrana?
It's a really tough one.
You can't say your own.
So can you? No, I won't say my own. No, because no, I would say actually I'm very, very impressed with what the boys from Citizen M have done.
Right.
I wouldn't say they're my favorites, but I think their growth has been absolutely incredible. I think they've created a product that really appeals, to a certain type of traveler, and corporates and leisure alike. I think they're tiny 12, 13 square meter rooms with the beautiful public areas. Yeah, I would definitely say, Citizen M if I have to pick one, but I admire a lot of them, so
All right.
hard to say.
Great. Tarek?
I'll go for a more obscure one. I actually came across it earlier this year. It's called the Body Holiday.
Pardon?
Body Holiday.
Holiday?
The Body Holiday. Check it out. They've only got, I think, 2 assets at the moment. It's in St. Lucia as well, as we were discussing earlier. And the concept is that it's a health and well-being hotel. So everything is around those health and well-being themes that people are into. But the reason why it's interesting for me is that because it's health and well-being centered, it means that you can get a longer occupancy cycle. So people who are into that sort of stuff will go in the winter, they'll go in the autumn. So actually, from a hotel perspective, seasonality is out the window, and you get a more stable occupancy rate. And they're looking to expand to Europe at the moment, so it's really cool.
Interesting. Emma?
I think for me, a rule of thumb with lending has always been that I approve of keep it simple. It doesn't have to be difficult. You don't have to add lots of unnecessaries to anything. So if a well-run machine such as Seiko, which is now rebranded as Eden, which gives you a good covenant for any potential service apartments.
Yeah, okay, good one, Sky.
I'll go with Vita Student, simply because of what they did. Don't worry, I was going to say you, but I thought it'd be too cheesy. Simply, they really sort of began a revolution in the student accommodation sector that now future generation do better, so it's fine. I think they were sort of a mainstay of the student accommodation sector in the sort of early 2000s and did great.
Finish off, Anthony.
Hotel brand, I've had some good experiences in Radisson Blu. I think in their newer assets, they've made some good use of tech, and they're just obviously they're larger assets, so they're more operationally efficient to run. So they're clearly making a ton of money from it. So not only is it a lucrative proposition, I think they deliver when it comes to the other bits and the customer service and the hospitality side of things.
All right.
And you, Piers?
I'd probably go Hard Rock, because I think they have got a authentic story behind the brand. And obviously didn't start in the hotel space, I suppose. So I'd probably say that one. Okay, thanks for your attendance. A quick round of applause for these beautiful people up here. Thank you.